10 minutes, so I'll be quick. When we're looking into the design of a protocol, what a few interesting discoveries that I wanted to share with you that I think are going to be quite topical for people that are experimenting with DAOs right now, with DAO governance, simply because the community is looking for practical use cases. And I really wanted to spend the following 10 minutes on what we see as probably the most practical application of DAOs, specifically in DeFi that we see right now. There's a quick chart tracing out the evolution of community-owned organizations, of which DAO is one. And effectively, what we can see is that from tribal groups to mutuals, to cooperatives, to cooperative banks, community banks, to DAOs, there's been community-governed institutions have been really the longest picture of human history. What is really interesting to observe is these organizations, in some shape or other, have existed for centuries. A lot of them are actually operating outside of the DAO framework as either mutual credit organizations or what's called water funds. They've been around for at least last decade in Europe. Essentially, the way they function is these are member-owned organizations that enable distribution of shared benefits to the users in situations where the market doesn't provide a solution to a particular problem, right? For instance, if we look at a case of let's say mutual credit networks, right? So they've been established. Probably the most prominent example is SADC in Italy. We have obviously VIS in Switzerland. They are effectively DAOs that provide a service that for one reason or another isn't provided by the financial institutions. It could be access to credit. It could be it could be access to insurance, or really basic financial services like savings account, remittances or deposits, and safekeeping of those. What we see, therefore, is an opportunity to actually leverage the current interest in DAOs to not to reinvent the wheel, but rather provide the framework to make existing member-owned organizations a lot more efficient, cheaper to run. So super pragmatic approach. Use of tech will reduce the capex. It will reduce the requirement for working capital. Most importantly, it will enable them to scale. Specifically, that means that one organization will be able to exchange value, extend credit with another. So what does that mean? It means that should that network be established, right? It will de facto act as a shadow banking network, right? If members of one DAO or co-op, you can call it co-op mutual, and I'll get into the details of how they're different, but it's mostly semantics. Can contribute value, so capitalize the treasury or the balance sheet of the co-op or of the DAO. If they can co-invest with another DAO, extend credit to another DAO, attract external credit, that describes 95% of the financial services that's supposed to be provided by the financial system, right? And it can be done in a way that's cheaper, a lot more efficient, and most importantly, is not part of the legacy banking system. So what does it mean? It means that when there is a financial crisis, what's called contagion effects. So did anybody here remember what was happening in 07 or 08 after the Lehman collapse, right? Cool. So I was at Lehman Brothers when that thing happened. It wasn't me pressing the red button, but I was involved in restructuring of the portion of the bank afterwards. Essentially, what happened is whoever collapsed an investment bank in the US, and we have regional economies in Europe that are massively affected by the fallout, right? So the domino effect is called the contagion risk, right? So what does it mean? It means that when one DAO, one corp, member-owned organization is financed by a bigger one, right? And there's a domino effect, it will go down, right? It will be effectively bankrupt or financially crippled, right? If you combine that with fractional reserve banking, you have very, very quick and easy to spread contagion risks globally. And this really is what happened in 07 or 08. And it absolutely will happen again because we printed more money. We haven't increased productivity. We incurred more debt, right? So we started by asking ourselves the question, okay, how can you prevent the same situation from happening where if you're a pensioner in Italy, you lose your pension because American bank collapsed, right? Some of my parents live in the Baltic states, for example, and, I've seen horrendous personal impact on people just because, let's say banks in Lithuania have been financed by banks in Denmark who haven't passed down the quantitative easing liquidity they received from ECB, right? Question, what does it have to do with DAOs? Why are we talking about this now? So, what is a bank? A bank, historically, and I'll draw attention back to the original slide, is basically a bunch of people putting money together into a common pot, right? That is a group of people split into those who contribute the capital and who govern the capital, right? Historically, we've got additional layer of complexity to account for fractional reserve lending and so on and so forth, but at its super, super basic level, that's what it is, right? So if we have finance-oriented DAOs, financial DAOs, you can think of a more elegant name. That's effectively a user-owned and user-governed multi-sig with the custodial function that can be, you can make it as robust or as focused on self-custody as you wish. If you enable a mesh network and communication exchange of value between those DAOs, what you have is basically a shadow financial sort of quasi-banking network that doesn't depend on legacy banking system, therefore is resilient to contagion risks. So therefore, when there is a run on banks, meaning you're going to a bank, you want to take the money out of your account and surprise, surprise, you can't, right? This happened before, it will happen again, right? This kind of network will, by definition, be very low on debt. It will be resilient to the risks inherent in a current economy. And the users, differently from the current setup, will actually be incentivized in growing the network simply because as a mutual, as a shareholder-driven organization, they actually get the distribution of revenues, right? What's interesting is that these groups already exist. They have certain difficulties with scaling, with with OPEX, so they are expensive to run, or legacy infrastructures are massively suboptimal. And this is where application of blockchain really makes a ton of sense, right? Of course, we are way off in terms of utilization of assets, but frankly, on a 2 to 3 year horizon, it looks really real. What we're seeing already is, for example, SADEX in Italy exchanging about 60 million of value per annum. We have what funds in Holland that focus squarely on social insurance, so social peer-to-peer insurance for freelancers, right? So they focus just on one goal, which is like you can't get insurance in the market because you work for yourself, right? And more people are going to be doing the same thing. Right? How do you insure yourself? It's done through a group. Is it through a peer group that on a regular basis puts money in the common pot? There's a trigger. If you are sick, something happened, you get a release of funds, right? The volume of funds released is proportional to the duration of your payout. Of you paying the funds in, rather. Yeah. So the main challenge that they have right now, as I mentioned, is its scalability, cost of, let's say, internal remittances or cost of transactions, and really up to now, it's been challenging to envisage how we can build that network, right? Where we don't depend on the banking system anymore. We don't depend on sort of largesse of banks or ECBs allowing us to take funds out of our accounts, right? Where we no longer have to expect a pension or social insurance that actually is simply not there, right? So the expectation and hope is, with the development of DeFi, crypto custody tokenization, on a fairly reasonable time frame, it should be possible to have highly efficient, lean, scalable, user-owned financial organizations that are effectively co-ops, right? That are superior to what we have right now, and can provide a real alternative to users in the event of a financial crisis. A lot of people in the community talk about Argentina, Venezuela, and so on and so forth. Guys, absolutely the same thing will happen in Europe, right? It's, if you follow economists, if you follow any, let's say, major hedge fund analysts, on less than, on whatever, 5+ year time frame, there will be very, very, very similar issues in Europe and in the US. And in our view, the only way to actually build a robust alternative is have exactly super lean, mobile first, essentially group governed, either self-custodied or custodied with a third party, multi-sigs of groups that can exchange value between each other, right? Exchange value, extend credit, provide insurance in a way that's very transparent, scalable, and gives you that freedom of not having to depend on a third party that inevitably never acts in your best interests.
Have they done any studies on the proposition that you've put together? At the ECB you mentioned, have they done any research on your protocol, and what have been the finding? Are they supportive?
So basically, so what we're doing is not new. Like, we're not reinventing the wheel. We're just making the existing structures, existing approaches cheaper, efficient, more scalable. Right? Yeah. So there is, ECB is a funny beast, right? Yeah. As any large institution, there is interest and support towards informal economy, right? And what we're talking about here will start in the informal economy, by definition, right? The size of it in Europe alone is estimated to be between 3 to 400 billion euros, right? That can be transacted outside of the banking system, and bypassing financial institutes, right? Obviously, they're keen to be able to capture it, right? There is support, do we count on it? Of course not. I mean, ECB is this institution that is responsible for things like deposit protection scheme, which means if there's a crisis, you go to the bank and you have your savings there, they will be insured up to a certain amount.
Same problems.
Exactly. But if the bank goes down, anything above the insured minimum is not going to be covered, right? And the same happened in 07 or 08, and it absolutely will happen again. We just have to look at the numbers and the research, right? So, I mean, any central bank is interested in a solution that makes them look less bad, right? Is there like active support? Not that I've seen so far.
Yet.
Yeah. I guess that's to be expected.
Yeah. Excellent. Thank you.